Hey everyone! Welcome back to Your Money Your Way. Today, we're diving deep into the world of one of Southeast Asia's banking giants, OCBC Bank. You might have seen headlines about their financial performance, but what's really going on behind the numbers? Is this bank a solid investment, especially in today's uncertain world? We're breaking it all down, drawing directly from the latest analysis. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Let's talk about the headline numbers. OCBC has been on a roll, hitting record net profits for 3 years in a row, culminating in a massive 7.59 billion Singapore dollars for the full year 2024. That's an 8% jump from the previous year. Now, looking at their most recent results, Q1 2025 saw a net profit of 1.88 billion Singapore dollars. That's a solid 12% increase from the previous quarter, although it was 5% lower than the record Q1 2024 performance. So, what's driving these results? Like many banks globally, OCBC is facing pressure on its net interest margin as interest rates decline. Their net interest margin fell to 2.04% in Q1 2025, down from 2.27% a year earlier. But this is where OCBC's diversified model shines. They saw robust growth in non-interest income. This includes wealth management fees, which were up 6% quarter-over-quarter in Q1 2025. Wealth management income alone contributed a significant 38% to total group income in Q1 2025. Net trading income surged a massive 31% quarter-over-quarter in Q1 2025. Insurance income was notably higher, increasing by 203% quarter-over-quarter in Q1 2025, partly due to better underlying performance and reversals of prior adjustments. This strong non-interest income, especially from wealth and insurance, acts as a crucial buffer against the net interest margin pressure, validating their strategy. Speaking of strategy, OCBC is heavily focused on its one group approach, integrating banking, wealth management, including Bank of Singapore, and insurance, Great Eastern Holdings. A key pillar is expansion in ASEAN and Greater China, with an ambitious target of generating 3 billion Singapore dollars in incremental revenue from this region by 2025. They've even unified their brand across these core markets to solidify this. Regional expansion is already happening. They completed the acquisition and integration of PT Bank Commonwealth in Indonesia in May 2024, strengthening their foothold there. They're also actively supporting businesses linked to the Johor Singapore Special Economic Zone. Beyond geography, OCBC is making big bets on digital transformation, especially AI. They're deploying AI tools internally like OCBC GPT for employee productivity and externally like Oscar for retail stock picking and Homes AI for wealth managers. They have over 300 AI use cases in total and expect AI use to double revenue in the next few years. They even recently acquired a minority stake in a fintech focusing on AI financial planning. This is clearly a major focus for the future. Sustainability is also core to their strategy. They have clear net zero targets by 2050 and a significant and growing sustainable finance portfolio, which reached 51.1 billion Singapore dollars in loans as of Q1 2025. They've been recognized as a top arranger for sustainable finance in the region. Now, it's not all smooth sailing. Macroeconomic uncertainties, trade tensions, and geopolitical risks are headwinds. OCBC estimates potential first-order impact on about 3% of its loan book from US tariffs, though stress tests show portfolio resilience. The bank is also proactively increasing allowances for non-impaired assets due to the uncertain environment, a prudent but noted move. Interestingly, amidst this uncertainty, OCBC's management has maintained its 2025 earnings guidance, expecting net interest margin around 2%, mid-single-digit loan growth, and credit costs of 20 to 25 basis points. This contrasts with some peers who paused guidance and signals confidence, possibly underpinned by their diversified income and prudent provisioning. What do analysts think? As of May 2025, the majority hold a hold rating, 56.25% of analysts surveyed. While they acknowledge OCBC's strengths, profit beats, and record performance, they're cautious about external headwinds. The average price target suggested some upside. From an investment standpoint, OCBC presents a compelling case for income-oriented investors. The bank has a strong capital position and is committed to significant shareholder returns. They announced a 2.5 billion Singapore dollar capital return program for 2024 to 2025, including special dividends and share buybacks. They've also increased their FY 2024 dividend to 1 Singapore dollar and 1 cent per share, representing a 60% payout ratio. The trailing 12 months dividend yield was reported at 5.3% based on an 86 cents TTM dividend. Return on equity for FY 2024 was stable at 13.7%, suggesting stable profitability rather than rapid expansion. EPS grew 8% in FY 2024. So, for those prioritizing income and stability, OCBC looks attractive. For those seeking aggressive growth, the picture is more nuanced due to net interest margin pressure and external risks. The success of their 3 billion Singapore dollars ASEAN Greater China target and their AI investments will be key to future growth. OCBC is a well-managed bank with a robust, diversified model, strong capital, and a clear strategic vision. They are actively investing in future growth drivers like AI and sustainable finance. However, they are navigating significant external headwinds like trade tensions and interest rate pressures. Their ability to execute their regional strategy and leverage technology will be crucial for their long-term success. What do you think about OCBC's prospects? Let me know in the comments below. Don't forget to like this video and subscribe for more financial deep dives. Thank you for watching, and I'll see you in the next one.